Everyone, welcome to this series of videos in which we'll be talking about metrics that are useful in measuring supply chains. In this video, we'll talk about financial metrics that are usually used to measure the health of a supply chain. And in another video following this, I'll also talk about productivity metrics that are useful in supply chain. I'll also have a video in this series to talk about supply chain drivers, the important pieces of a supply chain that drive the performance of a supply chain, and how these metrics interlink with those performances. Right? So let's get going. Now, talking about financial metrics, this is going to be a very short video. I'll just briefly touch upon the few financial metrics and then end this video. For the formulas of the other financial metrics that I don't mention but are given in the textbook, please take a look at the textbook. They are all very straightforward. You might have seen them in other, say, in accounting or even finance classes. They're very straightforward metrics, but they are important in figuring out how well your supply chain is doing. So from a shareholder perspective, one of the most important measures, summary measures for firm's performance is obviously the return on equity, which is the net income divided by the average shareholder equity, right? So that's how that's calculated. This gives you an idea of how much for every dollar of equity that exists within the company, how much money do you end up making. So that's the return on equity that you have. The next important performance metric is return on assets. Return on assets measures the return earned on each dollar invested in the firm by the firm in assets, whatever assets you have. So it's again calculated as earnings before interest divided by the average total assets, right? Now, remember that when calculating earnings before interest, you have to, the interest expense has to be multiplied with whatever is remaining. So you don't include taxes in it, obviously. So it's net income plus interest expense minus the tax rate divided by the average total assets, right? So that's one way. So there's another way of calculating ROA, which we'll see in a second, but this is, or for which the formula is in the textbook, you can take a look at that. But this is one way of doing it, right? Now, in the textbook, there are some data points here with all the calculations in here. You can look with all the data given here. Say, for example, if you wanted to calculate, say, return on equity, it's net income divided by average shareholder equity. So let's say you wanted to do it for Amazon. So it is net income. So you can look at net income. So net income for Amazon is $274,000 divided by the average shareholder equity. So liabilities and shareholder equity. So if you look at that, which is total shareholder equity is 9.746 million. Remember that this is pretty old data. This is from 2013. So the average, so return on equity for Amazon in 2013 would have been 274 divided by 9.746 million. And if you look at Nordstrom at the same time, around the same time rather, it would have been 613 divided by 1.913 million. Right, a couple of things to remember is that Amazon and Nordstrom are not exactly in the same business. Amazon does sell a lot of clothes on its website, but they are just a piece of what Amazon does. Electronics and books and all the other things that Amazon sells are a much bigger piece. And back in 2013, clothes were not a big part of what Amazon was doing. So they were not exactly direct competitors. So usually it makes sense to compare, say, your return on equity or return on assets, all of these numbers with what's happening within your industry, right? And see how well you're doing, competitors, important competitors, and so on. Right? A lot of these are relative numbers, and we'll talk more about that when I talk about productivity, but we'll get there. Now, the other interesting measures of performance are, one is the accounts payable turnover, right? So this is how much you have to pay. So this is the accounts payable turnover. This will be the cost of goods sold, the COGS divided by the account, whatever your accounts payable is, right? And remember, accounts payable is what you have to pay. The longer you can wait before you pay, once somebody sends you a bill, you have to pay it within a certain amount of time. based upon the contracts you have with them, you might have to pay them immediately, or you might have to pay them at the end of the month, or maybe at the end of the quarter, depending upon the kind of like I said, contract you have. So accounts payable turnover sort of calculates that. How quickly does your accounts payable get turned over, right? So that's an important metric. So remember, you want this to be slightly on the higher side so that you have some leverage, or you have some breathing space in case something your the money that you have on hand is not enough. So you want this to be on the slightly higher side. Now the other so once you have that, you can actually use that to sort of calculate you can use the asset turnover to calculate return on assets. So instead of calculating it just as earnings before interest divided by total assets, you can calculate it as earning before interest divided by sales revenue, which is obviously your profit margin, times your asset turnover. So just like you have accounts payable turnovers, you can also calculate your assets turnover. And assets turnover obviously is how much money you make divided by the total assets that you have. So that's another way of calculating return on assets. Right. So next is the accounts receivable turnover. So there are a couple of other turnovers that you can see here. You have accounts receivable turnover, which tells you how quickly your accounts receivables get turned over. And this is sales revenue divided by the accounts receivables. Then you have inventory turnover. Inventory turnover again is a very, very important metric that you need to keep track of. Inventory turnover is the cost of goods sold divided by the total inventories that you hold. So it's COGS divided by the inventories that you hold. And inventory turnover is interesting. It tells you exactly how long any inventory that you hold stays within your system, right? So one of the interesting things is one of the videos that I watched as part of one of the courses that I did was looking at how Lay's makes its chips, right? So when they make potato chips, they have to bring in a large number of potatoes. So the way they bring in potatoes is they literally bring them in train cars. So imagine a whole train car just filled up with potatoes, and they have multiple train cars of these that come in, and the inventory turnover for these potatoes is essentially 8 hours. Once the potato enters the system, it gets chopped up, it gets dried, fried, and all the other things that happen, packaged, and it leaves the factory all within 8 hours. So that's the inventory turnover within the factory itself. And then of course for the whole company, inventory turnover would also be, well, they sell it to their vendors or they sell it to customers, however you look at it. So inventory turnover is again a very important metric to look at. And of course you have the PPET turnover, the plant property equipment turnover, which is again sales revenue divided by the total plant property and equipment that you have. Now, once you calculate the accounts payable, accounts receivable, inventory, and PPET turnover, you can calculate something called cash to cash cycle. We'll talk about that in a second. Now, remember when I said you want accounts payable turnover to be as large as possible, you want the accounts receivable turnover to be as small as possible, because accounts receivable turnover is once you, whatever money you need to receive from your customers, how quickly do you receive it? Right. So just like you might have contracts set up where you have to pay your vendors at the end of the month, your customers might have to pay you at the end of the week or end of the month or whatever that is. So based on your contracts, you have a certain accounts receivable turnover. How quickly do they get turned over? Once you bill your customer, how quickly do they pay? If this is a retail setting, it's almost immediately. If somebody is buying something from you, they have to pay you immediately. But if this is a company to company sort of thing, you might have again weekend or month end or quarterly contracts based upon how well or how what kind of contracts are prevalent within your industry. So you want accounts receivable turnover to be as small as possible, accounts payable turnover to be as large as possible, right? Now with that, you can calculate something called the cash to cash cycle. So cash to cash cycle roughly measures the average amount of time when cash enters the process at cost and returns as collected revenue. So remember that accounts payable turnover is what you're paying to your vendors, accounts receivable turnover is what you're getting from your customers, and inventory turnover is how long something stays within your system. So by adding the 1 over inventory turnover to 1 over receivable turnover, you will know exactly how long it's going to take for you to receive money for the amount, for the inventory that you have. From that, if you subtract the accounts payable turnover, because that's how quickly you have to pay your customers, 1 over accounts payable turnover, it tells you how long it takes between something entering your system as cost and then comes back as collected revenue. So you're paying your vendors for raw material. So let's say you pay your vendors for raw materials, and how long do you have to wait before you have to pay them? And then in the meantime, you're holding inventory on hand, and then you're also receiving money from your customers. So if you include all of that, you can calculate the cash to cash cycle. Again, these are numbers that change from industry to industry, and it is important for this to be as small as possible, right? Again, you want money, you want revenue to come in more quickly, and you want cost to come in more slowly. So you definitely want this to be lower. Now remember, all of these numbers are usually calculated in weeks or days rather than, so if you look at all the formulas here, what you end up usually calculating is the ART, the APT, and the inventory turnover. All of these numbers tend to be per year, so it's yearly numbers. So even here, when we calculated them based upon all the financial data, these are yearly numbers that we are looking at. But when we calculate cash to cash cycle, we convert that into weeks by multiplying by 52. Obviously, 52 weeks in a year, so you multiply that by 52, you'll end up with a cash to cash cycle. Now one interesting thing is that cash to cash cycle can be negative, which means that you actually make money before you have to pay it, and that's a good place to be, right? So here are some numbers for industries in general. So pharmaceutical industries have a cash to cash cycle about 190 weeks, but if you look at consumer electronics, their cash to cash cycle is about 9 weeks, right? So it's much faster there because it's a faster moving industry. But look at apparel. Has a very large cost to cost cycle because it has a very large life cycle, right? A lot of apparel gets made in one part of the world and sold in a different part of the world, so there's a lot of lead time there. And then once the season is done, it gets sold from boutiques, it goes to places like Macy's. From Macy's, it goes to places like TJ Maxx and all of these other places which sell 2 or 3 seasons later. So it's a very large cycle, so it tends to be long. So if you 52 weeks in a year, so it's about 2 point something years for apparel. So cash to cash cycles can be anywhere from 9 weeks to almost 200 weeks for medical device manufacturers, for example. So it varies by industry. Right. So if you look at financial statements to measure a lot of these performance metrics, but there are some measures that are not part of financial statements, for example markdowns and lost sales and things like that, but that's not something that I'm going to talk about much. So but you know what they are, so just to remember that those things also exist. Okay, so I'm going to end this video here. So this is a brief look at the kind of financial metrics that you use and what they mean, and how they can tell you how well your supply chain is performing, right? Take care.